Okay, we're going to be starting right at 4 o'clock, and I hear the 4 o'clock whistle blowing. So we're going to be starting, and what we're going to be doing is we're going to be looking at a little bit of, well, there's the whistle. There, I don't know if you heard that, but that's the bell. I have Thinkorswim open. So that's the close of the market. Um, we're going to talk just a little bit about creating credit spreads, although really the thrust of this discussion is going to be how to manage them after they're in place. And I think when you see how to manage them, you're going to get a pretty good idea of the best way to construct them. Now, just want to go over quickly this mandatory disclaimer that all signals and trading opportunities that we provide are for educational demonstration purposes only. Everyone understands that participating in trading involves substantial risk and a person loses a substantial amount of money. Always be very careful and never risk more than you can afford to lose. Now, just a little bit about myself. I'm a graduate from an Ivy League university. I went to the University of Pennsylvania for 8 years, and I graduated with a degree in applied mathematics. After I finished my training, I graduated summa cum laude with honors. I was inducted into the Phi Beta Kappa Honor Society. And after I finished my training, it was my goal to do teaching. And I became a full-time professor at Thomas Jefferson University in Philadelphia, where I went to school at the University of Pennsylvania. And while there, I published 15 peer-reviewed articles in top-tier journals. I taught an enormous number of undergraduate and graduate students, which was a lot of fun and always very, very challenging. They ask tough questions. They don't mess around. They come to your office. They fight over grades. It's never a dull moment. Paul, I'm going to go into detail about Lockheed Martin. So it's really going to sort of be the key example. I have the chat open, and I'm kind of cutting myself off here in my flow to address Paul's issue. But what I want to show you is how to salvage a trade that appears to us to be a loser and how we have the potential to turn it into a winner. Now, we're going to go over all of that, Paul, in tremendous detail. And that's really going to be the thrust of this. I'm going to use Lockheed Martin as sort of our prime example of what can happen on a spread. Okay, no problem. So I've been invited speaker internationally in many countries and invited speaker domestically in many cities. I've mentored, I don't know, an innumerable number of traders, I believe close to 30,000 over the course of the last 12 years. And this is a purely educational session. I have no offer to make to you. I have nothing to proffer you at the end of this presentation, except my goal is for you to learn. And that, I think that makes it exceedingly unique. Now, anyone who tells you that trading options is easy, it takes 15 minutes a week, they have a new breakthrough code, they have a new hack, run away, because all of that is simply not true. If options were easy, we'd all be rich. If it took 15 minutes a week, there'd be nobody working in the United States. There's no breakthrough code, there's no new hack, and people are throwing these out there right and left. They're great ways to trade, and there are many optimal ways of trading. I'm not going to tell you I have the only one, but it takes work and it takes knowledge. And what is the latest failed fad? It's unusual options activity. A year ago, a year and a half ago, maybe 2 years ago, that was all you heard. Unusual options activity, unusual options activity. I would see it get run over constantly. UOA is simply one of a number of metrics we look at when we take an options trade. And quite frankly, I think it's nice to have on your side, but it is one of the less powerful metrics that we can leverage when we trade options. A lot of UOA is created by highly speculative, very rich traders. They take weekly options, they take 0-day options. You know, study it, but please understand that it comes with a huge caveat. And I usually never mention names about other people's services or other people's webinars, but I will mention these guys' names because these guys are, probably worth $500 million and they're on TV all the time. They're the Najarian brothers, and they started a service called Market Rebellion, and they came out with 100 million emails, and they started a service, blah blah blah. It's gone now because it was based on unusual options activity, and UOA simply fails very, very commonly. So we're not going to go for any fads, no hacks, no breakthrough code, no 15 minutes a week. And we are going to be way too smart to think that trading options is really exceedingly easy. Now, you have to trade options a lot like stock. In fact, stock is relatively easy to trade when compared to options, because stock is not only not a leveraged instrument, it doesn't have a time expiration. So if you buy a stock and you believe that the thesis or the reason you bought the stock remains intact, you get to hold it through thick and thin, and there's very, very little you have to do to manage it. As long as you believe the initial reason you purchased it is still operational. But options positions are very, very different. They have an expiration date, so they have to be meticulously managed. One, you can only trade liquid positions. And I'm still doing this for another service. I trade some semi-liquid positions simply to give traders the opportunity to leverage 100 shares rather than having to buy them. They're always awkward positions, and the reason is market makers cannot figure out where the midpoint is. And when they can't, you're going to see dramatic shifts in the value of the option that is simply an illusion. If you actually put into Thinkorswim a sell price and say this huge positive value, you won't be able to get it. And if you try to sell it at this huge negative value, you won't be able to get that either. It's simply them fiddling with a midpoint that they can't fix because there's not a lot of traders moving into the position. And you have to constantly use the same strategies. You cannot vary them. To some extent, they have to be cookbook, and I'm going to show you what we do on how we manage a credit spread position that simply goes astray. Now, 85% of our credit spreads are going to evolve into winners. And of the 15% that don't, we're going to have the opportunity to go in and not only band-aid the trade, but to modify the trade in a way that can actually provide us with significant profit when we come out of that dark tunnel and we come back out into the light and we wind up trading in the green. I'm going to show you exactly how it's done. There's no hidden code here. Now, I do want to review a little bit about credit spreads and just remind everyone that there are 5 positions or 5 directions that a stock can take. Now, if you have questions, just go ahead and ask them. I may not answer them until the end. I really wanted to address the Lockheed Martin issue because I know that may be a sore spot in a lot of traders. I did not have the ability to send out a lot of the remedial ways to fix that spread because I hadn't gone over this, and I didn't want to send out people who are on board on the service ways to fix it in which they just wouldn't understand and would send them rushing to the phone or rushing to their email. Now, this will never happen again because of this session. And this is just one of a series of sessions that we're going to have. Now, I invited a few additional people to this, but you're only going to be able to attend any future session if you're a member of the service. Now, a stock can trade flat, and you can anticipate that with the stock in consolidation, give or take some minor variation, some intrinsic market oscillation, that stock is going to remain flat. You can take a mildly bullish view of the stock. It's going to appreciate in value, but not significantly so. You can take a mildly bearish position on the stock. It's going to depreciate in value, but not appreciably so. And these are the three. When a stock trades flat, it's got a mild bullish or mild bearish anticipation. That's when you want to trade a credit spread. Now, we need other factors also to be operational, but that's an important one. Because if we believe that the stock is going to take a major move up, we're going to buy a call. And if we believe it's going to take a major dive to the downside, we're going to buy a put. We're going to do everything we can to make as much
Hey, Mark, I think we lost your audio. Give Mark just a second to get his audio situated. We're just having a small technical difficulty here.
How about now? Can you hear me better now?
Yes, now we hear you, Mark.
Okay, I just unplugged and replugged in the mic, so.
Great.
So I hope everyone got that last thing I said. And the last thing that I mentioned was how important it is to preserve the capital in your portfolio. That is the #1 mandate we have. Before we can worry about making money, we have to worry about protecting what we have and ensuring that we don't lose money. Now, a lot of people refer to credit spreads as time spreads, others as volatility spreads. I believe that there's an element of both. We want to trade a credit spread when we have volatility leveraged in our direction. I'm going to show you exactly how to do that. I have my Thinkorswim platform open, and eventually we're going to move over to it. When I show you Lockheed Martin, I'm going to show you a tremendously advantageous way that Lockheed Martin offered us to make a huge amount of money back. But I'm going to show you how I look to take trades right off the platform. So we're going to look to take trades that have a lot of implied volatility, and our anticipation that as the trade matures, we're going to get that arrow coming, and eventually it's going to hit that volatility bubble, and volatility is going to leak out of the spread. Now, we want the value of the option to be as small as possible. Remember, we're selling it to someone else, so we want to buy it back super cheap. So as it diminishes in value, the amount of money that's actually accrued in our portfolio begins to rise. You know, it's like you can be either the auctioneer, or you can be sitting in an audience. And you want to auction something. Well, you want to sit in the audience when when the auctioneer is selling something really cheap. So if something really cheap, we're going to buy the option. But if something is really expensive, we're going to sell it to someone else and let them have it. Now you're going to see what can happen to us if we do. This can also happen to us on a credit spread, and it's called assignment. I'm going to show you exactly how we're going to manage it. Now, the optimal credit spread is a 45-day to expiration position. Now you're going to see the maximum amount of time that we're going to set, that we're going to hold it, is only going to be 30 days. The last 14 days subjects us to gamma whip, which I'll explain a little bit more as we continue. We're always going to sell the 50 delta, and we're going to buy the 25 delta. If we're bullish, we're going to use puts. If we're bearish, we're going to use calls. Now I'm going to go over the spread, and I'm going to go over how much money we want to make based on applied volatility on another slide. But this is really key to making money on these spreads. Now, I just wanted to show you my scanner. That's something that I'm going to talk about later on in other sessions that I hold. And now a scanner, I know that there's an enormous number of people marketing scanners and telling you they're gonna hand you just these amazingly profitable trades. But a scanner is a dumb tool. And anyone who tells you there's an AI component to scanning is full of baloney. I mean, AI implies self-learning and self-modification. And these are all fixed algorithm systems. I mean, they don't go in and fix their own algorithm and modify their own code. That's real AI. So this is just a snapshot of the scanner. And right now it's showing you that Apache, at the time that I snapped it, had a premium width of 40%, an IV rank right here, pretty low IV rank at 12%. And it gives you which leg you're the strike price, the expiration date of the position. It really gives you all the information you need. But you really have to do a lot of due diligence on what the scanner is telling you, because if you don't, you can run into huge problems. The scanner is a great place to start, but it is not the place you necessarily want to finish. It's going to give you potentially good trades, but you have to vet every single trade it throws in your face. Now, this I consider to be credit spread best practices. Now, I've looked for 80% max gain, and we've gotten it. Gotten it on Valero. I think we got 70% on another position. But in general, if we hit 75% of our potential net credit, we're out. If we hit a stop that's equal to 75% of our max gain, we're out. Now, dovetailing back to Lockheed Martin, it just blew through. I hadn't set up a stop because I hadn't anticipated that would happen. It wouldn't have helped us anyway. I'm going to show you the trade. All it would have done was crushed us if the stop was in place. And we're going to exit 14 days prior to the position to avoid gamma whip. And gamma whip, to really explain to you really simply, is gamma is the only second order Greek that is out there. And gamma is based on delta and theta. And it looks at both of these. As you near the end of the expiration, for every incremental change in the underlying value of the stock, it's going to dramatically change the value of your option position. It's basically because you lost all extrinsic value you are motoring right now on all an intrinsic value. So gamma, if you look at Thinkorswim, and I have it on my phone, and one of the metrics that I look at all the time is gamma. And it's great when you own the position. When you have sold the position, gamma whip can just destroy a profitable trade and turn it into a loser in an hour. Because let's say, I'll give you as an example, I'll give you a tremendous losing position I took. And this is about 4 or 5 years ago. I can't really pinpoint it. It was on Disney. Now I was up 98, 99% of my potential credit going into options expiration, but I held the position. You know, it's really easy to just let it expire and go la-di-da and do nothing. Because both positions, both of the puts that you have sold will expire out of the money. They're worthless and they vaporize. But on that Friday, where I was subjected to tremendous gamma whip, a small boutique brokerage destroyed Walt Disney, and it took its biggest loss in 20 years on the day of options expiration. And I went from a 98% winner to a 100% loser. I lost $40,000. I remember I was sitting in CVS and a lump in my throat, and I wanted to ask the pharmacist for a couple of tranquilizers. So I will never do that again. So we're going to close the position 14 days prior to expiration. Now we're always going to look at 4 stocks in the best performing sector, and then if there's a subsector within it, we're going to look at the stocks in the best performing subsector. We're always going to look at blue chip stocks, the best of the best of the best. And a couple of the positions we lost are really unfortunate. You know, I set a net credit. Some of these positions just run on us. We lost the our credit spread on the semiconductors, on the semiconductor ETF, and man, it ran like crazy. We would have gotten a full winner. There's another position too that ran on us, and I know what it is. It's Novavax. Now Novavax has since come back to earth, but on the news that 3 COVID vaccines were up for approval in front of the FDA, we tried to get a credit spread on Novavax and it just ran away from us. But we're going to look at the best stocks in the best sector or best subsector. Now, the premium width is really important. Now, I'm giving you as an example our trade, a bear credit spread on CSX. It's a position that we're holding right now, and it's really jockeying around. Now, we wanted to close under 31, under 31 bucks, although we have plenty of room underneath the spread for us. I mean, it could close at, I think at $31.60, and we're still going to make 100% of our net credit, because what we do is we have a premium percentage of 40% and an IV implied volatility rank 30%. And you see, we're simply selling the 50 delta and we're buying the 25 delta. And instead of using puts, we're using calls. And that creates a bearish credit spread. Now, optimally, we want the position to close under 31. I'm going to tell you why in a second. Although if it creeps above 31, gets to 31.25, 31.30, even 31.50, we're still going to make 100% of our potential net credit, but we're going to close the position out long before that occurs. So now I'm going to show you exactly what we do. Now, in order to trade credit spreads profitably, you must take one of the key components, and I hope I'm not losing a lot of people. Remember, this is not easy material to assimilate. This is going to be recorded. You can listen to it again. If you come aboard, I'm going to spoon feed you the trades, how to manage those 15% losers that we're going to get. And of those 15%, I'd say some of them will give us the ability to band-aid them, and actually make money. Now, we can take a $1 wide spread, or we can take a $15 wide spread. The best thing to do is keep the width of the spread small, because it's a mandate, and this is not optional. This is a must. Now, it doesn't make any difference how much risk you allocate per spread. That's up to your portfolio size. It's up to your risk tolerance, but it's got to be equal across the board, or this will not work for you. Now, let's say that you're going to assume $1,000 of risk per spread. And on the trade that we took, that I just showed you, on CSX, we're assuming 60 cents of risk per spread. We stand to win or make 40 cents on every position that we place. So we have to look at the 60 cents or 60 bucks, know that, okay, you know, I'm going to risk $1,000 on the position. So I have to create 16 spreads. That's a must. If we take a 15 wide spread and the potential profit is $6 and the potential risk is $9, then you can only allocate enough money to trade one spread. So you can see we have a lot more configurability and a lot more ways that we can close this trade out. If we take trades that have a small width, now I'm going to go over that a lot more. I'm not going to take any more trades that are $15 wide. I'm going to even try to keep them. I took a trade on Amazon that is only $5 wide. The expense of the stock is irrelevant as long as we have applied volatility in our direction, and we get a really nice net credit that is about 40% of the width of the spread. So hang in there. I'm telling you, it's all going to make sense to you. Now, here's the width of the spread. Now, what I want to do here for a second is I want to drop this. And what I want to do, I can't really do it. I'm going to have to blank out the screen for 1 second. So you can't see it. So what I want to do is I want to move in a JPEG I can write on. And I want to open it with Paint. It's the same slide you're looking at, and I'm going to move it over, and now I'm going to reshoot the screen. Now here's the slide. Just going to move it over to the middle, right here. Now, let's say that we take, and I'm just going to move to the drawing tool. Let's say that this is a $1 wide spread. It'd be nice if I could draw, but I can't. So from here to here is $1. So here's the 40 cents that we can make. Here's the 60 cents that we can lose. And there's the $1 wide spread. Now, the worst case scenario that can occur to us, now any place in this zone, I'm going to go over this more with different slides that really show this better. The only point I wanted to make here was the width of the spread is really up to us. We can trade a $1 wide, a $5 wide, a $3 wide, a $2 wide. It does not matter. As long as the width of the spread provides us with the ability to sell the 50 delta and buy the 25 delta. That's the only mandate that we've got. And if we can do that and get a really nice net credit, and I'm going to show you on Thinkorswim how it's done. Now at expiration, if price ends up any place in here, we're going to make money. If price ends up any place in here, that's called being middled on the spread. Now, there's no action that we can take. There's no way to band-aid this trade, and this is going to be a full loser. And there's nothing we can do when you're middled on a trade. Now, in terms of options assignment or stock assignment, the only time you're going to be assigned stock when you're middled on a trade is either the day before expiration or actually at expiration. If it expires on a Friday, you're going to wake up on Monday and you're going to be assigned the stock. Because remember, you're being given a privilege. You're selling something that's very expensive to some other trader who's willing to take it off your hands. But they have the absolute right to stick you with the stock if it doesn't go the way we want. So we're not going to let that assignment occur, and we know exactly when that assignment will take place. They're not going to risk assigning us the stock because they could get beaten up on it until this position just about expires and we will be long at it. If it falls to the bottom of our $1 wide or our $5 wide, that's when we got problems. I'm going to close this slide up. And I'm going to use this one now. And this one I think is pretty much self-explanatory. I don't really need to write it. So I'm just going to go back to the deck. And I'm going to go from current slide. So now you have a little bit of idea what we're doing. Here's our bracket. Now this could be a $1 bracket, a $2 bracket, a $3 bracket, a $5 bracket, a $10 bracket, a $15 bracket, a $25 bracket. It doesn't matter. It's up to us as long as we're selling the 50 delta and buying the 25 delta. And we're doing it about 42 days out from the expiration date of the option. Now, let's take a look at, I just created a position on Amazon. Now, Amazon took a little bit of a hit today, but it's very, very early. And it came down about $2. Now, well within our width. Now, Amazon, I sold the 140. Let me see what I did with Amazon. So I can actually give you accurate numbers. I sold the 140 and I bought the 135. And we got 40% of that $5. So I'm not going to try to figure it out. Well, $5, 40% is $2. So we lost about $2. So we're almost right here, right in this zone. We will make some money at expiration. Amazon closed at 137.51. So it's early, but it's still a good example. Optimally, we want Amazon to close as we move into expiration above 140. We'll walk away. I'm sorry, I muted the mic. I apologize. We'll walk away with close to 100% of our net. I don't know why I muted that mic. We'll walk away with 100% of our potential net credit, and we're in great shape. Now, since we're taking a $5 wide with a 40% net credit, we have $2 to play with here, where at expiration, if it falls in here, we'll wind up making some percentage of our net credit. Now, if Amazon falls right through it and moves into this dead zone here, we're going to take a full loser, but it's not a lot of money because it's only a $5 wide, and you've limited your loss potential with the fact that your asset allocation only allows you to lose a specific amount of money. Now, if it falls through the bracket, like Lockheed Martin did, we're going to go through all the metrics on Lockheed Martin. This is when we could get assignment at any time. This is when we're looking at a 100% loser. And this is where we can repair this trade in multiple ways. And I kid you not when I tell you that I am way up on Lockheed Martin, even though most of the traders are not up. It's simply because I didn't have the configurability, nor did they have the knowledge for me to provide them with everything that I did. And I knew it would have caused mass confusion. I really was in a conundrum because I don't want anyone to lose money. But Lockheed Martin really gave us a great opportunity to make money. Now, when again the stock falls through this bracket and Lockheed really took a nosedive, we have to be concerned about assignment. There's going to be someone out there that is going to want to nail us with the stock. Now, most traders, now I took assignment on the stock. Now I'm holding one freaking boatload of Lockheed Martin. Now up to today, I was up a ton on the stock itself, but today it came back. But I'm in I'm not panicking. Lockheed Martin is a blue chip defense stock. Every day they're awarded another contract. I think it's going to trade right back up to its 52-week high. I'm not stressed out. I'm holding it. But most traders are not going to be able to do it. So we're going to manage the trade as if you get assignment and then you're going to have to roll out of the stock immediately. And that's how we're going to take these trades. I'm not going to assume that you have the portfolio size to hold $100,000 or $150,000 worth of stock. And if I take assignment again, I won't be able to hold it. You're going to have to roll it out. So here's Lockheed Martin. Now, we sold the 450 put and we bought the 440 put. Now, we got $5.60 of net credit, but that wasn't in the bank. That was our potential net credit. And we risked $940 per spread on the trade on a $15 wide trade. Now, a $15 wide is just as good mathematically as a $5 wide or $1 wide. It just doesn't provide us with the configurability that a smaller width does. So we're going to keep them smaller, and I'm going to tell you why. Let's say that we're trading a $1 wide and you have the ability to buy 15 spreads. We can take half of those spreads off when we have 70% of our potential net credit, hold the additional with a stop in place, or even a stop plus 10%. So the worst that can happen to you on the remaining positions that you're holding in your account is you're going to get stopped out and make 10%. When you can only buy one spread, you don't have that kind of wiggle room and leeway. It's all in or all out. So we're going to take a look at what we're going to do when the stock falls through our lower zone. What I'm going to do is I'm going to go to Thinkorswim. Take these down for a minute, and I'm going to put up Thinkorswim. Let me find my Lockheed Martin chart. It's right here. Now, here was that huge gap down. Now, I just want to tell you that I saw the news. It's always, I think it's exceedingly important that everyone look at their portfolio pre-market, because what's going on pre-market is often a harbinger of what's going to take place when the market opens. Now, Lockheed Martin, you can see pre-market. This is pre-market that already gapped down. Let me just go to drawings and go back to drawing tools. Let me just go back to the line. So Lockheed Martin pre-market had gapped down. Now it gapped down about $7. So I knew we were in trouble. And the only news out on the stock was that it was slow walking the delivery of its F-35s. Now, I personally, as an investor, would have just shrugged at that and not really thought it much of anything. Now, the F-35 is the most advanced fighter jet in the world, and every single country is fighting and tripping over themselves to own them. And the United States will only allow certain countries to own them. In fact, it was a big deal when they just gave approval for Turkey to buy 35 F-35s. So they announced that they were only going to deliver 85 F-35s in 2023 instead of 150 F-35s in 2023. They also announced that it would not impact their bottom line. So I figured, okay, this was going to be news. We would get a gap, and then buyers would come right in, and they would take the stock up and create a floor for us, because this is minor news. So the first thing I did is you got to open up your platform and see how the stock behaves right at the open. And my anticipation was right. Lockheed Martin, and if you look below, you've got good volume here. And you can see that buyers came in and they pushed the stock up on really good volume. They sort of created a floor and a really nice pivot for us. Now, when the stock rolled over right here on this growing amount of volume to the downside, here's where we could come right back in and for very little money buy a whole bucket of weekly puts. Now, I did that. Now, this is a Wednesday. These puts cost me 18 cents to buy. That was all it. That was it per put. We'll talk about the assignment in 1 second because I'm going to go over all that back on the slide. And I just held. I knew I had Friday expiration. I had really no extrinsic value. It was all intrinsic. Now I had to get out of the position on Friday, which is right here. And I closed, I made $8 per contract on the contracts that I sold. I'm sorry, on the puts that I bought. So that's $800 per contract that I made. Now, the number of contracts that I bought is irrelevant. I just want you to see how you have the ability, if you look. Now, the next time this occurs, you're going to know what's going to happen if we get a gorgeous signal like this. We may not see something as beautiful as this. When buyers come in and then we break right through this support, and we're doing it on big volume, we're going to take a weekly put. So even though we're down on the position, if you want to take 7 or 8 puts and add another $100 of risk to the position, it's really not a big deal. And you have the ability to really come back and almost bring yourself right back, not only to break even, but put yourself in the green. Now, I'm up $4,000 on my Lockheed Martin position, because I did even more than that. Now, after I marked it out where I did it. And let me find out right here. I bought a credit spread on Lockheed Martin. And I bought it out to December because I wanted to see nice broad-based consolidation. And this is all evolving from the credit spread we sold. Now I'm going to buy a debit spread. And you can see the debit spread is up a boatload of money. Now, in addition, I'm going to take it all the way to the right edge, so I include today's pullback. And there's today's, still up 1 ton of money on the credit spread. Now, I took assignment on the stock. At, I'm going to show you the assignment price. So I'm definitely down on the stock. But you know what? I'm holding it and I'm making money back. Now, on the weekly puts I purchased, I made a ton of money. I'm making money on the stock I was assigned, but we're not going to assume that anyone's ever going to hold the assigned stock. You're just going to roll out of it. Now, anyone who is assigned the stock is going to take a loss on the stock. There's no way that you can get out of it. Now, I'm going to go back to the slide and I'm going to show you the metrics. And in fact, to do that, I may have to actually open up something else. So I want you to see all the metrics on the trade. Hang on 1 second, I'm gonna do it. Now, I think we were assigned the stock at 455 bucks. So if you rolled out of it, you rolled out at a loss for sure. And there's nothing you can do about it because we were really creamed on that news. Now, we're not going to get very many trades like this. I don't know why this isn't opening. Okay, I don't know. Hey, Rory, do you think you can text me the password? It may have been changed in iContact because I can't log into iContact. And you know what? I don't even need to. Hang on 1 second. I'll show you. All I have to do is go into my emails, and I'll show you the metrics of the trade. I wanted them to be clear to everybody, so I laid them out. Just let me go to correct one. Okay, that came up. Let me get that. Let me get that out of there, Rory. That but we're good. Okay, hang on 1 second. It's not this alert. It's my other alert. I'm trying to put together so many different metrics here. You're just going to have to give me a little bit of leeway here on this. Here we go. Let me see. Here, this is where I have all the metrics. Oh, the reason I'm opening up the wrong email. Here it is. Okay. So here's the Lockheed Martin trade, and this is how it appears in the newsletter. The initial trade was we sold the 450 put and we sold the 455 put and we bought the 440 put. Now, one of the other things that we did, we were assigned at 455. So we're going to roll out of that, and we're not going to get 455 on the stock because it will have gapped lower. So exactly how far At gap lower, I'm going to show you. But we're still holding the 440 put. Now I put in an order to buy it back or to sell it when we hit $16.24. Now the reason I did is because we went from 440 to 420. So Lockheed Martin was trading 20 bucks below the lower lip of our credit spread. And that is a long way down. Now we had some extrinsic value. So instead of making 20 bucks, we made 16.25. Now I just simply called Thinkorswim, and we initially purchased that position for $3.66. They split it out for me on the spread. We made $1,624 on that, 444%, which we are able to subtract from the gross amount we're going to lose on the trade. Now, the stock was assigned when Lockheed Martin was trading at 420, and it was assigned at 455 per share. So at assignment, you're going to lose $3,500 on the stock, and you're going to make $1,624 on the position. So in balance, you should be down about 2,000 bucks on the position if nothing was done. But there were, as I showed you, there were major ways to band-aid this trade. So you didn't have to lose anything. Now, I'm not going to assume that anybody is going to take assignment on the stock. And I assumed a maximal loss on the stock. Now, Lockheed Martin is not trading at 420 anymore. I'll tell you where it's trading right now. Right now, it's trading at 425. So your loss, if you were able to take the stock, which I'm not going to assume, your loss is 3,000 minus round off 1,500. You're down 1,500 on the spread. If you just would have bought 5 or 6 puts, now I bought a lot more because I had more spreads, you'd be up on the trade. And then if you went with a debit spread, which I also did, you'd be up even more on the trade. Now, I'm going to go into Thinkorswim. I'm going to tell you exactly where I stand on the spread. Now, I hope this is understood. This is all not easy, and I don't expect everybody to get it right off the bat. But I'm telling you, when we review this over and over, God forbid this is going to happen to us again, but listen, there's nothing that's going to, some kind of horrific thing could occur, and we're going to lose the trade. Let me go to Lockheed Martin. And right now, I can tell you where I am. Right now, I'm down $1,339 on the trade. Now, I have a lot more spreads, so I'm holding a lot more stock. So it's only put me down a very tiny percentage. I am very, very confident that I will ultimately make the money back. But even if you didn't take assignment, it is totally irrelevant. If you bought the puts at the position that I showed you, it's the wrong chart. Let me find Lockheed Martin again. So I'm looking at all kinds of new stuff here. And let me find my Lockheed Martin chart. Here it is. For 18 cents a piece, and I know they were 18 cents because that's what I bought them. That's what I bought them for. Right here. And you only could potentially, the max you could hold them was 3 days. They were going to expire. Now, they were going to expire in the money, but I just bought, I just sold them. And I made about $8 per, per put that I bought, which is an enormous amount of money. So there's a lot of ways to band-aid these trades. Now, the one thing that we don't want to happen, let me take all this out. And remember, I'm in these trades with you. Now, it's a pretty rare service where the guy who was offering you the trade is also in it with you. Now, there's going to come trades where we're going to get middled. And when we get middled on the trade, we're going to sit and we're going to do nothing. Now, the longer we hold it, the smaller our net loss is going to be, because even though we're looking at a full loser, we want that full loser to be close to our minimum full loser, but we're not going to be able to take it out 42 days. If we do, we're going to get assigned the stock, and then we got to roll out of it. So this is obviously, when you trade credit spreads, you got to bring every single thing that you can to bear. The most important thing, I'm going to go over the most salient features on this trade. Number one is that you must check the chart the morning of the trade. That's an absolute. You have to have your chart open and look and see. At some point, buyers were going to come in at Lockheed Martin. I mean, it's a blue chip, and I wanted them to come in on big volume, and this is where they did. And this is where it rolled over, and we could take an ultra safe position here to the downside. And man, did this thing buckle. I mean, it really buckled. Now, when this hit 420, right in here, this is when I took the put that we owned and we sold it. And we made 444% on that put, which mitigated our downside loss significantly. If I had simply sent out the order to buy a put back here, all of you would be sitting in the green right here. Now, we're not always going to get this gorgeous kind of setup, this continuation to the downside, but we got it on Lockheed, and we're taking blue chip, super powerful stocks. These are not, when you trade a credit spread, you don't take it with a stock that's speculative. It's going up on some rumor or the potential for a blockbuster, a new drug to come out. This is where you're going to only trade blue chip stocks. Now, I believe, sort of to bring this to a close, and I'll answer questions. I know this was a lot if you're not familiar with credit spreads, but I'm telling you, if you remember this service, you will learn to master them. Now, we will get middled on about 10%. Out of 100 trades, we'll get middled on 10% of them. And there's nothing we can do. We're going to take a little bit more than a full loser. So we're going to lose about 1.3 to 1.4 of a winner. But if we can win 85 out of 100 trades, we're going to trade massively in the green. And we should be in the green right now if you took an equal number of spreads with an equal number of risk on every position that we have taken to date. Now, I could have gotten you this put position. I just didn't feel comfortable throwing it out. Remember, this is a credit spread service. All of a sudden, you get an order to buy a put. I knew that it would throw a lot of people into sort of like, into a cerebral overload, because you have to know what you're doing. And I don't want this to be a black box system. I'm telling you, you'll make the money back on Lockheed if you didn't take assignment. I assume you didn't. We may have other positions in 2 months or 3 months. They'll blow up. There's nothing you can do on it. We have controlled risk. We're only going to limit how much money we can lose to the downside. We take assignment. You're going to get it at night, and you're going to look pre-market right here. You're going to see where the stock opens, and you're going to get right out of it. Now, there's one more thing that I want to tell you, that by law, every brokerage, it has to give you 72 hours to cover the margin call. So please do not lose your, don't panic when you see a margin call in your account, if you see one. They must give you 3 days to mobilize the amount of money required to cover the position. It is not legal for them to sell it out from under you in under 72 hours. So even with the margin call nipping at your toes, if you believe the stock is going to trade lower, get the heck out right away. If you believe that the stock is going to trade higher, well, when we will take this position by position, we're going to use 24 to 48 hours to hold the position with the margin call, knowing that we're safe as can be. We're not breaking any rules. We're not doing anything wrong. But if we can make back 10 to 15% on our stock position, trading with the brokerage's money and they have to loan it to you, we're going to do that as well. So there are lots and lots of ways we can band-aid these trades. So let me drop this chart. I just hope that everybody understood that. And I have to tell you, I know. Now, the next educational session is going to be how to locate optimal trades. I want to show you something really quick, right off the platform. Now, right here, I'm looking at the difference between NVIDIA performance and the performance of the S&P 500 going back 18 months. And what I'm doing is I'm comparing the performance of two stocks. And what's really nice about Thinkorswim, it gives me to do that on a percentage basis. So if you held the S&P 500 going back to March of 2022, all the way through today, you'd be up 36%. If you bought NVIDIA, you'd be up 618%. So I'm just doing some comparisons. But let's go back to Lockheed Martin. And we're going to go to trades. And this is how easy it is to take these trades. Now, first of all, we know that just by looking at our calendar, about 42 days out, here's 1, 2, 3, 4, 5, 6. We're going to look at about on October 20th. That's not going to be enough. Now, the problem is, and this is why I did this with Amazon, I like to trade monthlies and not weeklies. So we took an Amazon position. But say we want to trade right now, today, a vertical on, and you can see, I told you I have an Amazon right here, the 140, 135. We got $2.25 in net credit. And you can see I traded it with 10 spreads. This is my working order. So you get to see that. Now, forgetting Amazon for a second, I'm going to actually zip that up. Let's take a look at the Lockheed Martin position. Now, Lockheed Martin closed at 425, right here. Now, right here is a 47 delta position. Now, we want to sell the 47 delta. Now, you're going to hit your control key and then go up to the 25 delta. Right here, you have a 26. And we're gonna buy the position. Now, if we did, we would have a 425, 412 and a half, let's see here. So I can't add. Uh, 12, 20, that's a $12.50 spread with a $3 net credit, which is lousy. So we never do it. But you can see building these trades is super easy. So we can delete that and let's go to another trade. Let's take a look at something with a lot of volatility. Let me go to my TD Ameritrade and look at something that's bouncing around quite a bit here. Now, I don't like to trade things that are bouncing around a lot, but and we've had some stuff on a tear like Sigma Lithium. And let's see here. This was a position that I was very seriously looking at over the weekend. It was Albemarle. So let's take a look at Albemarle. It's trading at just right around 180. So if we look at the 180, that's as close to a 50 delta. You can trade the 182, but you want the 180 because that's where it's trading at. It's trading at 179.99. So we're going to sell it. I'm just going to hit the sell. Then you're going to hit the control key. You see this? You see in the upper right, this hotkey setup, and you're going to go to the buy, and you're going to click that. And on a $10 spread, you're going to get a 36% credit-wide credit spread. That's a halfway decent trade. The only problem is on a 10 wide, 170, 180, your upside is 360, your downside is 640. So you're really only going to be able to trade one spread. And I want to keep them cheaper than that. So I want to keep the price of the stock less than Albemarle so that we have a little more configurability. But this is how easy it is. Now, I don't have AI, I don't have implied volatility. I need to format it on my desktop. I have it on my phone, but the IV rank is really important and will help us find trades. I just configure most of these trades right off of my desktop, or right off of my phone. So I'm going to drop it, and you can see how easy they are to format and how easy they are to look at and see what you're going to get. I mean, I think the best are the $5 wide spreads where you get at least, or optimally you get $2 out of 5. You risk 3 to make 2. That's a terrific credit spread. Now remember, we're trading 50 delta credit spreads. Now, if we were simply to toss a coin on a 50 delta, we should win half and lose half. So we're really trading with great probability on our side. If we add a little bit of smarts, a little bit of fundamental analysis, and a little bit of technical analysis, and we have an anticipation, I believe that Albemarle is going to make a marginally bullish move up. Nothing really strong. I wouldn't take a debit spread on it, just because of the present environment. But I think it makes for a very, very nice potential credit spread. Only it doesn't have much configurability because you can only take one spread. So we're going to go with a cheaper stock, and I'll just show you one cheaper. And we'll just go with MRO. Let's go with VLO. VLO, we traded successfully. We made nice money on VLO. What did I do wrong here? Put VLQ. Okay. Now here's VLO. Now Valero is trading right now. I mean, if we look at the chart, it's really in a major uptrend. Now the problem is, I don't think we can get, we can get a 52 delta at 144. I don't like that because we're trading a stock that it's trading at 142. We want it to trade above the option we sell. So I don't want to sell a 144 put. I really want to sell a 142 put. And we can do that at a 45 delta. So let's sell it. Now let's buy with the hotkey the 25 delta. Now on a, let's see here. On a 7 wide, we make 232. I'd have to take the percentage there and see what we get. But I would like it to be close to 40%. I don't think we're going to get that. So, you know, Valero is just not in our ballpark right now. I just wanted to show you how they're configured. So let me go to any questions that you have. You can see I take a considerable amount of risk at 10 spreads on Amazon. I believe Amazon is going to close above 140, and I don't think we're going to have any muss or fuss on it. I really don't. I mean, today it took a little bit of a drawdown, but I don't care. I mean, nothing is going to evolve perfectly. Let me just go right down to the end, and I think this is the last slide. So if you're a member, in about 2 weeks, I'm going to show you how to optimally locate these spreads. I'm going to show you how to work the scanner. And let me tell you, in a market like this is a very, very advantageous way to trade. Because the market doesn't have much of a trend. And when you don't have a great trending market, this is a terrific strategy. You've obviously minimized your loss. You know all the rules. You know how to band-aid a trade that falls through the lower edge of your vertical width. And we're going to bring everything we can to bear to turn every trade into a winning trade. So I'm down a tiny percentage on Lockheed Martin. I've got a call on it, and I own the stock. Like I said, though, forget the fact that I own the stock, just the fact that I own a call going out to December. It's actually a full call spread. It was not expensive to buy. I believe that, you know, we were all going to make money on it. From now on, we're going to band-aid these trades all in tandem, and we're all going to resurrect trades that fall to the bottom of our vertical width. So let me answer any questions. I know that, listen, options, this is what you don't ever get to hear. And that is the tough part of trading. I mean, everyone tells you it's super easy, blah, blah, blah. And it isn't. And if you want to trade profitably, these are the kind of things that you have to know. I mean, I'm sort of letting you in on the truth. I mean, when a trade doesn't go in your direction, what are you going to do? Are you going to sell it if it's an option, or are you going to roll it in a way that provides you with the potential to turn a loser into a winner? And that's what you'll always want to do. You never want to capitulate on a trade, especially when the market gives you great opportunities to step in, and in a low risk way, you're going to add to your risk, but the risk is really taking is really marginal. So let me just go through any questions, okay? I'm sorry if the quality of the sound, I don't know why that is. When we take a spread, it usually says how much we risk. Why would they not just sell both positions instead of taking assignment? Well, remember, Paul, you're going to take assignment. It's a good question, and let me show you why. You're going to take assignment on the 455 you sold. What someone is doing is sticking you back with the stock at that 455 level. You're not going to get assigned at the 440 that you own, because the stock is this is an in the money position. So why would anyone take assignment on that? If they do, they're handing you money. If Lockheed Martin is trading at 420 and you get the stock at 440, you're going to be making $20 for every share you're assigned. So that's why they're only going to stick you with the losing side of the position. And it's always going to be the put you sold or the call you sold. If you're taking a bearish position and it rockets through the top, the position you sold is going to be one that's going to go sour, and that's the one you're going to take assignment on. The other one is going to be in the money, and so that one's untouchable. In fact, that's the one that's worth gold to us, because if we can continue to bank on that, to continue against us. We rolled up a 444% profit on that particular position, and I gave an order to everyone to sell it at that price. So everyone should have been at it right there, Paul, and that's why you're never going to get assignment on both legs of that spread. That's why we have to be careful when we're middled. When we're middled here, we're only going to get assigned on the losing edge, on the losing side. We're going to get assigned on the 455. We're not going to get assigned on the 440. This is the one that's always going to take us, but no one's going to give us assignment until right into the end, like the day before the expiration or the day of expiration. Believe me, you are not going to get assigned 2 weeks out like we did on Lockheed. Lockheed, the stock has to really crash for some other investor to assume that kind of risk. Okay. And I'm going to be holding your hand from now on this in a lot better way than I was able to do with Lockheed. Yeah, no, I did see Ivy right. You're right. Got it late because of time. Probably, can you send me? Yes, we will send you a link to read this. No problem. Hey, Tom, the problem with assignment differs by brokers. TradeStation goes incommunicado, and you cannot get in touch. If you are a small fish, they manage to keep several $100s in slippage. Before I could get out. Just saying assignment usually sucks, and I'm hoping to avoid that. Listen, Tom, I'm the one who's telling you assignment is horrific. We never want to get assigned. All I'm saying is you have to try to get out, roll out of the stock at the best possible price. And listen, it is a law that you are allowed to hold the stock for 72 hours. But usually in a case like this, you're going to get out of it right away, because the only way that Lockheed Martin in this particular case was going to trade lower. So if you take assignment, it really does bite the bullet, so to speak. But like I said, if you would have bought 10 calls or 10 puts at 18 cents a put on Wednesday of that day, you saw the rollover. You got $8 on every single put you sold. You would be way, way up on the trade. So I'm telling you, there are ways we can band-aid it, as long as we get a nice continuation like Lockheed Martin did, and we don't get middled. Robert, pros and cons on SPX. I'm just trying to, hang on 1 second, I'm trying to understand. Let me just get that. SPX, I don't know exactly what that is Robert. It looks like an ODTES, and I'm not sure what that means. If you could retype it, I'd appreciate it. Listen, we're going to keep, you know what, unfortunately, Paul, everything that we could do on Lockheed Martin has passed us. There's nothing that we can do at this point on Lockheed. I mean, right now, it is just trading at the whim of traders. I can't call a direction. I really can't. And like I said, the worst thing we can do is take a loser and make it bigger. I mean, all the things that we could have done were done within the first 3 days of the position. All I can promise you is that will never happen again. You're going to get ways to manage this trade. Be on the lookout. Be tight to your computer or your phone. Because if we get a rollover like we saw with Lockheed, and a beautiful way to take a short position on it. I'm going to send it out, buy as many puts. I never tell you how many. Buy as many as you want. Assess the risk. That was an ultra low risk way to make back 1 ton of money. I'm telling you right now. I mean, I did it and it really made me a boatload. I just wish to God I could have sent it out. That will not happen again. Hi, Mark. It all sounds good. I've asked for a trade list of at least, okay, Alex. I will send it out to you, Alex. I have been really bowled over, but I will. I promise you. On the SPX, 0 days to expiration, Robert. I don't like trading 0 day. Listen, I get why they're traded, but you know what? Listen, let me ask you a question. Do you really think you can determine the direction of any stock on a 1 day basis based on technical or fundamental analysis? Obviously, the risk is unbelievably small. I mean, that's where you're going to get your 600, 700% winners. But man, I'll tell you, institutional traders get mangled on 0 day options. I personally wouldn't trade, but that's just me. Because I don't believe that I can determine in 1 day what's going to happen. XBA used in 0 date SPF, SP500 cash settle. I'm not sure what that means yet. Listen, I'm not that familiar with 0 day options. I'll be perfectly honest with you. I hate to give advice on something that I just don't have a lot of knowledge about because I don't trade. So I don't know, the nuance, the ins and outs of them. So it's better I steer clear when I don't have a great idea of what I'm doing. I do trade in credit spreads. If we take another loser in which we're not middled, we will band-aid the trade. And we will not let another Lockheed Martin happen again. So that's all I can promise you. I mean, I didn't let it happen to me, but I was just very hesitant to send buy those puts out. I didn't think that most people would understand what the heck I was talking about. And then I didn't sell out the bull call spread because I also didn't think people would know what the heck I'm talking about. Now you all do. And now you're going to get all these trades. And I'm telling you, whatever red you're swimming in on Lockheed Martin will be quickly dissipated and go back to them. So listen, everyone, we're going to be back in about 2 weeks. I'm going to show you how to find the optimal credit spreads that are out there. Obviously, there's a lot of technical analysis. That's what the scanner is going to help us with. We're also going to look at a lot of the fundamental analysis that drives these stocks. We're going to look at the strongest sectors. We're going to bring our brain to bear because you really have to do a lot of vetting before you take a credit spread. But if you do, and you take a 50 delta spread, just as a toss up, you should win 50%. I mean, unless you have bad luck, 50% should be winners and 50% should be losers. That's not good enough because you're always going to risk more than you can win. So you have to trade about 60 to 65%. And if you can trade 75 to 80% like we're going to do, you're going to make great money as long as you asset allocate risk across every position equally. And I'm telling you, we're going to band-aid any future Lockheed Martins that occur. So listen, everyone, have a really, really great evening. You're going to get a recording. I hope you learned a lot from this. I mean, options are a tool. I mean, like somebody comes and they build an addition onto your house. I mean, and they bring hammers, they bring screwdrivers, they bring all kinds of things. This is the way to leverage every tool in your toolkit to turn a loser like Lockheed Martin into a winner. And I'll tell you, very commonly we can. And you're going to see that as we move forward. So have a really, really wonderful night. Feel free to email me with any questions that you have. And we're going to have another session in about 2 weeks. If you're not a member, this will be it. But if you are, we're going to go on ad infinitum. Everyone, have a great evening. I really thank you for your time. Good night, everyone.